Hello, Houston. Welcome once again to On the Money with the team from Allied Wealth, Matt Stevenson, Peter Lott. I'm your host, Spike Spangle. Fellas, how you doing this week? Peter, I'll start with you.
Spike, I'm awesome. Get to be here with my good buddy Matt today on TV.
Glad to be here
again.
with you.
It doesn't get any better than this, does it?
No, but the markets can actually get a lot better than what's been going on.
True.
And that's part of what we're going to be talking about today. We know that there's a lot of folks out there who are investing on their own, or they're saving into their retirement accounts. A lot of people are thinking about pausing that because of the market being downturned right now. And so we want to talk about the different kind of advice that certain financial advisors are giving out there, the different kinds of advisors to actually use. You two both are financial advisors, but not all are created equal or have the same kinds of offerings. Am I right there?
Correct. Very correct. And Matt, you know this, I know this. There's a lot of different types of advisors that are out there that do a lot of different things. And one of the things is when I bring a client on, educating them first how financial advisors are compensated. How do we get paid, right? You need to know that. And the thing is, most people that come in the office, Spike, if they've got a current advisor, Matt, do they rarely know how much they're paying for their advice?
Rarely, if ever, Pete. And, so often, even nowadays, the landscape has shifted some in recent years. But a lot of these guys and gals are still working with these big box companies. And don't get me wrong, they do a great job at what they're designed to do. But so often it's, how do we get started investing through those accumulation years, taking advantage of the volatility that the market has to offer and, being able to grow our wealth as best we can.
It's interesting you say that, taking advantage of the volatility. So the volatility that's going on right now, there's actually a couple of positive things about this, because if you are working and knowing that you're not retiring for another 5, 10, 15, maybe 20 years, you're actually getting the market on sale right now. That's the positive. But if you're in that retirement red zone, a few years, 2 years, 3 years away from retirement, this doesn't look so much like opportunity.
And guys, I kind of think of it like, not to be too philosophical, but climbing Mount Everest, right? So as we're saving, as we're going through our careers, we're in that accumulation stage. And as we're putting money in, sometimes it's at all-time highs for the market, sometimes it's in dips for the market, just like we're seeing right now. That's actually what we call dollar cost averaging in over a long period of time. And that's a great thing to be able to take advantage of. But when we're in retirement, the last thing that we can afford to do with your life savings you worked your tail off all those years for is to reverse dollar cost average out of the market. Meaning when we have declines such as this year, and we're compounding that fact by taking money out for the income that we need to maintain our lifestyle, that can lead to a situation, if we have too much volatility and ups and downs in our retirement plan, to where we risk running out of money. And that's exactly what we want to avoid happening.
You have to avoid that, right? And we see this. People are coming in, they are pulling money, they're taking income distributions, right? And maybe they started with $1 million back last year. Well, now through market loss and distributions, they're down 30, 35%, and they're continuing that same distribution path. And we talk about all the time, we call it risk capacity. You have to slow that down. Those income distributions have to come down to match what your balance is now. The thing is, most people can't afford to do that because you've got this time right now where inflation is at all-time highs. It doesn't really have a lot of, we don't see that slowing down anytime soon. So people are really getting hit hard right now.
Exactly. And going back to, the guys and gals that we see most folks still working with, again, we won't name names here or pick on them, but these big box companies, we all know who they are. We see their commercials on TV often.
Right.
And oftentimes what they're doing, it's more the retail side of the business. So they're offering products and services to which these guys and gals get paid a commission to do so. So think back when you were first starting your earnings, your savings into your career, maybe saved away 10 or 20 grand, and you're just looking to make those dollars work as best you can. And you take those dollars to one of these retail firms, they probably recommend some stocks, maybe some mutual funds.
Yep.
So we get some professional management, we get hopefully some diversification to manage risk, and we get our dollars moving in the right direction. The benefit there, though, is the advisor earns a commission, let's say 5%, for example, which would be $1,000 on a $20,000 investment. There's nothing wrong with that.
And thank God they're there to get us started, right? Because if without them getting us started there, you may not have a start in getting
Exactly.
Well, because I was going to ask you, when you're inside, you're investing inside your retirement accounts at work, how much investment advice are you really getting from your 401k provider? You know, I've seen those slidable scales that will tell you if you put in this much and it possibly makes X amount of dollars, 5% or 7%, you know, you might accumulate this down the road. But a calculator isn't really giving somebody investment advice of telling them which kind of funds they should actually be invested in.
Most investment advice is probably done around the water cooler.
That's true.
Right? Or their neighbor, maybe.
Friend Billy Bob at work, or cousin Mary Sue down the street. Who knows? But when we think about that type of advisor relationship, and it's been prevalent for decades, we talk a lot about the psychology of investing and why advisors actually work with their clients in the first place. And with the retail side of the business, it's often what is the motivation to work with that client, and there it's to sell products, services, mutual funds, and move on to the next sale. That's how these guys and gals earn a living. Again, there's nothing wrong with that. But as you grow wealth over time, as you're saving into retirement plans, maybe other types of investment accounts, that number becomes pretty large pretty quickly. So let's say that you grow that $20,000 to $200,000, take that basket of money to the same retail firm, they earn another 5% commission. That's $10,000 that oftentimes is coming out of your pocket and into that advisor's pocket day one.
So you better have some quick returns just to get back to even.
Exactly.
Right?
So,
exactly.
But when somebody walks into the firm of, like you say, these big box firms, we see the television commercials all over the place. We hear the radio commercials, even around our show that you do every single week, 1 hour of programming that you do there. How do people know the difference of the kind of advice that they're going to get when they're walking in the door? What kind of questions are they supposed to ask?
It all comes down to education, right? So people don't know what they don't know. And that's why it's so important for us as fiduciaries. We hold a legal responsibility to our clients to put their interests ahead of our pocketbook. And so going through that education on what are the different types of advisors that you can work with. There are major differences. We've talked a lot already about the retail side of the business, where they earn those commissions. They have a set menu of products and services to offer, and maybe they're tied to what's called a commission grid. They sell a certain amount of that product, and they earn more by the end of the year. It's actually the opposite side of the coin from where we operate. We're more what you'd call a wholesale or advice-based advisor. So we work with our clients for an annual fee to build relationships. So again, adding value to our clients' lives through good, if not better returns than what they're getting right now. How do we manage risk through these crazy market environments? How do we keep our relationship cost effective? And we're not tied to a set menu, Pete. That's one of the coolest things that we have to offer people.
Matt, and I'm calling you Matt, but actually it's Blade Stevenson.
Let's make sure it's
no
right.
more Matt. We need to get Matt out of the vocabulary. It's Blade from now on. The thing that gets me on the wholesale side, and being a wholesale advisor myself, is my interests are aligned with my clients' interests. I want to see their accounts grow. I want their $100,000 account to grow to $200,000, $300,000, because if I have an annual fee I'm charging on that, I'm making more money too. They're making more money. It's not a situation where an advisor makes a commission, now they're gone, they're looking for new people to make this another commission on. It's a deal where I want to grow with my client. I want my client to grow so I can grow behind them.
You're rowing in the same boat with them.
Absolutely.
If the account goes up, then you're fortunate enough that your annual fee is going to be a little bit more. And the thing is, if the markets do go down, which you don't have any control over and your clients don't have any control, then you'll make less on that fee.
So I've got an invested interest with my clients, right? Because I want to make sure if the market's up, we're taking the biggest benefit we can, the upside. If the market's down, I want to limit that downside as much as we can.
Peter, Matt, I've got to take a very short break right now. I'm going to tell folks out there about the financial flight plan. If you would like a review on not only your investments, but your tax situation, what is going to be your healthcare situation as you go into retirement, even legacy planning, call for your own complimentary start to your own financial flight plan, a financial flight plan all the way through retirement. 844-944-7555 is the phone number. Write that down, do it right now, or you can use the QR code on the screen if you want to look and find more information. More On the Money with Matt Stevenson and Peter Lott when we get back right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to On the Money with the financial advisors from Allied Wealth, Matt Stevenson, Peter Lott. I'm your host, Spike Spangle, and I've got more questions on not only the types of advisors, but when should we start using an advisor? I mean, 30s, 40s, 50s, 60s. When we're getting ready for retirement, when does that start for you?
Yeah, so once we've accumulated resources to where we feel like maybe it's too much of a burden to continue doing this on our own, for our own benefit, for our family, our spouse, it's time to seek some help there. And we've talked about different types of advisors that you can work with, but at the end of the day, we need to understand, no matter who you work with, if anyone, how do we actually invest our money to build a plan and achieve the success that we need all the way through our golden years? And there's several different ways that we can invest. Some of them are in the market, out of the market. And Pete, we talk oftentimes about, Wall Street wants you to believe that you have to put all your money in the stock market, S&P, Dow Jones, to have success, and that's not true. Right?
Blade, I hear it every day. The thing, I got good this time. All just right. Blade. It's just Blade. Prince did the same thing, right?
There you go.
I hear it every day. What are the ways that we can invest and take less risk? And I have out-of-the-market investments that we like to educate our clients on every day. And out-of-the-market investments get market-like upside. So when the market goes up, they appreciate in value. They have limited downside when the market goes down. So you don't have to participate when the market's doing what it is right now, right? You can be a little bit safer approach.
So when you're saying out of the market, you're saying not stocks, not bonds.
Stocks, but they have a tie to the market. But you're not invested directly in the market. And when someone calls in, we can explain that in much greater detail, obviously. But what it allows you to do is get market-like upside without having to take the risk of the market. You're going to average anywhere between a 6 to 8% return on average with these vehicles. There's oftentimes no fees associated with these vehicles. And when you're talking about a bond replacement right now, it's a phenomenal vehicle for that. Just because you've got the risk with bonds that can lie there when we're seeing interest rate hikes like they are right now.
Blade, I see you tilting your head on that. A good replacement to bonds, or possible?
It certainly can be. That brought an interesting thought, Pete. When we talk about bond replacement, you mentioned the interest rate environment, and it's important to understand the relationship, because a lot of folks think bonds are a safe money investment, right?
Right.
And if you hold them for 5, 10 years, however long that bond lasts, it can be a good way to protect your principal and get some interest. But a lot of folks don't do that, especially if we're investing in bond funds. Those are actively managed all the time. And so that brings in interest rate risk. And so remember when you were a little kid riding on the teeter-totter, right? The same relationship applies to bond values and interest rates. We've been in a declining interest rate environment for 4 decades now, until now. And now as we're seeing rates rise, the value of bonds are actually declining in value. So that makes them inherently more risky. And so we're looking to shift risk away of us owning a bond or a bond fund to be able to protect ourselves and get the same type of return over time.
That's why we have Blade on TV with us, right? I bring
that's
the
why
Blade
I'm
out here for a reason. Without him, I'm just mowing over stuff. So we got to have Blade here.
And using a financial advisor, what about that period in our life when we're in the market but we're passive? I kind of consider this the time during our retirement accounts that we're working in our 30s, our 40s, even into our 50s.
Yeah.
Do we need to be sitting down? What do you mean by passive in the market?
So passive management, a great example would be a 401k plan, right? So, this is what most folks are taking advantage of through work, your company, and we should. Let's sock as much money away as we can. Let's build that savings. And oftentimes we see that it's going to get all the market upside, but by seeking all the upside of the market, it can leave us open to all the downside risks the market has to offer too.
If you come across a big market meltdown like 2008 or where we're at right now, you've just got to have the time to recover. And if you're in your 30s, that's not a problem at all. If you're 35, you're putting in the 401k, I think that's great to be passive. I'm passive myself. As you get into that retirement red zone and as you near retirement, it may be time to get off that train and get into something that's a little bit more managed, as opposed to just letting the thing go out there and ride on its own. Because the last thing I would ever want, and the last thing I want from my clients, is to see them in a situation where retirement now has to be postponed or go back to work.
Right. But
Or
if
any of the
they're
things that you can
still
do that you
working
can-
and they're still contributing to those accounts at work, they're, 58, 59, 60, what do they do? Are you saying to come to a financial advisor and invest now outside the retirement accounts at work, or are you able to take a managed look at them and help them out with those?
Me and Matt every single day help our clients that may be a little bit younger have a 401k that they're working with and help them align that with
what you want to do.
we're doing, what we want to do in retirement, so that they're not just sitting ducks out there when one of these trigger events comes by and it washes away 25% of their life savings. We can kind of help manage that.
And one of the things that we see all the time, Pete, is maybe you worked for a company for 10, 15 years, maybe you switched jobs.
That too.
So we've saved a chunk of money away into maybe an old 401k plan. You've actually got the ability to roll that to an individual retirement account where you can take better control of these dollars. That's a situation where we can help guide you there and maybe diversify the type of investment strategy that we have to get as much growth as we can, but also help to manage around some of these risky environments that we're seeing right now too.
But Spike 2, there's the in-service withdrawal that starts at age 59 and a half. So if you're at 59.5 years of age, you can actually roll your 401k into a self-directed IRA and have much greater management of those assets. Now, what's cool is your 401k stays intact. You're still contributing to it.
We still contribute.
Yep,
We still get the
getting
match.
You're getting all that good stuff, all that free money that we recommend doing.
Yeah.
But now you've got the bulk of your funds with someone that can actually
And by
help you.
free money, you're talking about the match,
match,
from your
yes,
employer,
yes,
right? So you're
absolutely.
getting that match from the employer. You're keeping the 401k going.
Yep.
But you're taking a chunk of it if you're at 59 and a half and if your plan allows to. Call your plan provider to find out.
We help with
if
that,
you're-
by the way. We will help walk you through. We'll get on the phone with your 401k provider and ask those questions that you probably don't know to ask and help figure out and guide if they'll allow you to do it. But I
Are
would
there
say
tax consequences or transaction fees for doing something like this?
nothing. There's no tax consequences. We don't charge
So what
any
you're doing
fees
is
to
you're
do that.
taking possibly the savings of several $100,000, if we're being realistic, what you've saved into your retirement accounts at work, 401k, 457, 403b, and having somebody else professionally manage it for you instead of, as we were saying, the passively being in the market. You're passively investing in the market in your 401k, but no one's got their hands on the steering wheel.
Exactly. And like we're talking about, guys, that can be a good thing to take advantage of the market through these ups and downs if we've got the time to be able to do that. But think about what the market's done the last 20 years. It's been crazy. We had the dot-com crash. We had 08, 09, COVID, whatever the heck this is going to turn out to be. Who knows? But several times we've seen the market drop by more than half of its value. And sure, over that period of time, looking at in entirety, the market's done pretty good as far as the average growth. But if we think about, say, the first decade and a half of the last 20 years, the market averaged a goose egg, a 0% return. And most folks can't afford to get a 0% return over a decade and a half when they're getting close to having to use those dollars for a reliable income stream.
Peter, I'm going to hit you because we've got to get out to a break right now. Tell folks out there about the financial flight plan. Let's say that they're passively investing in the market. They're still working right now. What can the financial flight plan do for them?
Yes, Mike. So the financial flight plan is going to allow you to discover how much risk you're taking with your portfolio, which I think is enormous. It's going to show you the ability to see what past returns will look like. It's going to create a legacy plan for you. It's going to help with tax efficiency, which is huge. If you don't have a Roth IRA, please start one now. Call us. We can get one started for you. Legacy benefit. Am I missing anything, Matt?
Healthcare, income plan.
It's going to take care of all that in one comprehensive package that we will design specifically for you.
Peter, Matt, we'll be right back. Folks, call right now to get started on your own complimentary financial flight plan from the team here at Allied Wealth. 844-944-7555 is the phone number, or you can open up your phone and go to the camera, use the QR code, click on that, and it'll take you right over to their website. More On the Money with Peter and Matt when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to On the Money with the financial advisors from Allied Wealth, Matt Stevenson and Peter Lott. I'm your host, Mike Spangle. There's so much to financial management. Which advisor do I use? What kind of advisor? We're talking a little bit about passive management. Now I'd like to talk, if you don't mind, what exactly you use at the firm. I think you phrase it as tactical management, but I'd like a broader understanding of what that is.
We do, and to clarify, we use any type of investment strategy that our clients are comfortable with, and that's why we go through this education on what you've got the ability to do with your dollars. A lot of folks don't have any business or want to be in the market, so that's where we'd look for some protection, the out-of-the-market stuff. We talked about the passive way of doing things. Maybe there's some volatility and some variability that creeps into the equation there that we're looking to rein in as much as we can. So a lot of what our clients do to counterbalance that is we take a tactical approach to how we invest. And it can be a bit misunderstood at times because we're not seeking all of the market upside. So here's an example. If the stock market goes up 10% next year, perhaps we're seeking a 7 or 8% return there. But on the flip side of that, it's much more focused on minimizing what we call drawdown, or the potential for loss in a challenging market environment. Think about this year. The stock market's been down as much as 25% already on a couple of different occasions. A lot of folks that we're talking with from the show, the radio program as well, they're feeling the brunt of that. And so we're seeking to minimize that loss potential as much as we can, to take the variability out of the equation and get more consistent results over time.
Now, when you're saying things like minimizing the loss, let's use a horrible analogy. If we go to Vegas, right? And one way you can minimize losses is by not putting too much out there. But if you don't put too much out on the table, then you can't win that much, right? So when you're saying you're minimizing losses, I'm also assuming I can't get all of the gains that might possibly be out there. Is that what you mean by tactical management?
Not necessarily. So we're still seeking really good returns over time. And you know, there may be years where a single asset category, like the stock market, outperforms something like tactical management. That's where we want to consider each type of way that we can invest these dollars to grow them. But it's in retirement so much more about, I've built this nest egg, how do I preserve it? I've got to generate that reliable income stream to not run out of money or income over the next 20 to 30 years for myself, my spouse, my kids, all of these different variables. That way I can have a high probability of making it to the finish line and being able to maintain my lifestyle.
Matt, the biggest thing in retirement is removing the big chance of loss.
Yeah.
Right? Because if you've got, simple math, if you've got $1 million and you have a 50% loss one day, you've got $500,000. This is extreme. I'm just talking to get, on TV, right?
Right. What market are you
I don't know what
looking
you're
at?
invested in, but you got a terrible advisor. Right now, you've got $500,000.
Well, it happened in COVID. In a matter of a few days.
So let's say tomorrow, next week, that $500,000 has a 50% return on it. Most people think they have their $1 million back. They don't. They've got $750,000. You
got $750,000
right?
because you made that 100% back on half $500,000.
Yeah. So people don't get that bottom line back until they see this return. It just takes a long time to get back to even. You add in distributions in retirement, and good luck getting it back, right? So you absolutely need to minimize the risk that you could lose half your life savings, and that's what the portfolio X-ray will do. Is it'll show you how much risk you're taking inside your portfolio, what's lurking underneath that thing that you may not know about. You're seeing it now. Right? People are coming in, their statements are 20, 25% down.
Yeah.
They're living this. Most of them had no clue that it could take a turn like that.
That's a great point, Pete, because the more loss that we experience, especially if we're tied to something like the stock market, the more energy our money has to put forth just to get back to where we started. And that takes oftentimes a long time to happen. And when we're in retirement, we simply can't afford to do that. And so what we're seeking to do is to take the emotional decision-making off the table, because that's when it creeps in the most, when we have the potential for huge losses. And we use math, rules. We want to tie in other types of investments beyond just the stock market, like the bond market, real estate market, commodities, international investments, even the dollar at times, to be able to get that consistency. And folks, this is exactly what we do every single day. If you've got questions about that, we're here to help you. Simply give us a call. It's 844-944-7555. Check out our YouTube channel as well. It's On the Money TV, and alliedwealth.com is our website.
Peter, Blade, thank you so much. That's going to be all the time we have. Thank you for watching On the Money. Call for your own complimentary financial flight plan. Thank you for watching.